I just can't see you kind of scrolling
It
down.
was the Chinese heard that I was excited about something, and I was going to push a button, and they thought it may have been thermonuclear. So, hey, so I thought your explanation of Elliott wave was absolutely clear. It's the first time I've actually really understood it, which is kind of funny if I can tell a story here, because Jeff Boccaccio, who's a trader over in London I work with, he's on the Society of Technical Analysis on the board. He just interviewed John Bollinger for an hour and a half, and Jeff and I have been working together. He said, "Hey, what do you think of Ken Long's stuff on his patterns?" And Bollinger said, "It's absolutely sound. What he's doing with Bollinger Bands is intriguing and unique, and it's very sound." And he says his stuff looks a lot like Elliott Wave, which Bollinger is in favor of because it has stood the test of time. So one nice statement like that, and I'm good for another 20 years, right? So Elliott Wave, I think, is absolutely sound, and I want to show you how, as a monkey-style trader, I'm going to try to create the planning norms that will allow you to create a robust system around this. So the first thing I want to talk about is let's see, let me get my little drawing machine here. Yeah. The first thing I want to talk about is this. Everything that you guys are doing is resting on solid work. And what I look for when I'm sort of validating the ideas, I want to make sure that your in-sample test, the one you use to develop the rules and test it, is diverse enough that we have a multiple market conditions, long periods of time, different economic policies, different macro conditions, so that we have some sense we're not curve fitting. And then I want to see that the out-of-sample data that you use was not used in the construction of the rules, but also has the same characteristics as the in-sample, which is it's a robust test of many market conditions to see if it still works. Then you're going to make a decision to trade it forward. Now here's where I'm going to offer an idea about the rule about when to stop trading. You mentioned a good one, using a drawdown percentage as a money management realistic percentage. Hey, if this thing performs like that, then I'm going to stop trading. Another one I want you to think about is if it is in a period of statistically significant underperformance, then I will stop trading. I will keep taking the signals, but I'm not going to put risk capital on it. And here's what I mean. If I've done my work correctly with the in-sample and out-of-sample, and I've made my decision to trade it forward, like a monkey, here's how I'm going to do it. I have an expectation based on expectancy of what the perfect performance would be going forward. And then I'm going to study that performance and establish a plus or minus one standard deviation boundary. And then 2/3 of the time, if this system is working forward the way it did working backward, 2/3 of the time, my performance should be inside that envelope. That is normal behavior. You're not supposed to change the system. So if it gets above that line, it's not because we're smart, it's because we're lucky. Or what was the change in the world that now made this thing amazing? Because that was not present during the back test, probably. Now, this is a good problem to have. When I talked with Chuck Whitman about that, he said, man, he had a problem where some of his PhDs were getting much better performance than expected. And I said, and he was going to stop them from trading. And I suggested, hey, take a look at the trade-by-trade performance. How much risk did they ever have on at any one time? And if they were within risk tolerance on a trade-by-trade basis, then all you had was exceptional performance to the upside. Let them keep going, provided that you don't let them think that they're smart. Because what you really care about is this bottom control limit that says when that thing comes out of normal, that's when you stop risk capital, but you continue to take the signals and then reset and then say, now, when is it back in normal? Now, if you trade a production system, what you want to do is periodically reset this so that a period of long outperformance doesn't mean you suffer this entire drawdown before you stop. When you reset after every, 100 trades, 200 trades, and recompute the statistics going forward, then you have the ability to examine performance and not relative performance and not just drawdown percentage. If I'm trading in this way, what I have is a production system. And if I have a system that's positive expectancy and statistically sound, I want as many opportunities to trade it at the smallest level of risk possible in order to get the expectancy and not rely on a fat tail. Now, how do I go from this decision to trade forward and then let the system be? Well, I'm going to paper trade it forward until I'm satisfied. I like to put $1 at risk, buy one share, so that I have skin in the game, and then trade it 100 times. And for $100, I know something about that system that I didn't know just from the back testing. Cost you $100. That's why I actually reduce the amount of time in back testing and accelerate the time where I'm trading $1 of risk forward on a good enough idea, because I want to know if I could even trade it. I don't want to wait. And I'm not that good at math. Now, once I'm satisfied that it's still performing the way I expected, I can increase to $25, maybe to a half of a risk, and then full production when it's getting a standard unit of risk per trade, just like all my other production systems. Then I also want to know, based on where it is in this performance curve, is this the time to surge, to add gas, go to adrenaline? The bottom line is I like to start off with a certain amount of money for this system at low rates, and then as it is working, let its performance increase the size of the potential until I can get my initial risk out, and now I have a unit of developmental risk that I call DR that I can put on a new system that I want to trade. But once they're in production, I just let them go. So that is sort of a way to scale into these systems and move them into production so you can achieve your objectives. Now, I want to talk about trade framing and the reward to risk ratio. What you described in Elliott Wave was what I like to do on the other side of this thing when it's failing, is I love to see a great big failure, because that's true, and I love to see some guys, young guys, come in to try to hold it up, and we're strong enough to actually push it up. Well done, fellas. And then if this is my manageable risk box, this thing is either the world is going to believe these guys and off it goes, or all the fat cats that crush this are going to come in and say, oh, dead cat bounce, and they're going to crush it. When that thing violates the low, I am so absolutely already into this that you can't believe it. And so this little pattern number 2 of mine, which I love, is actually the setup for my most favored pattern. Now I want to talk about and here's why, psychologically. I get to be wrong about that trade, and I get to make money on my favorite trade. So with my good Catholic upbringing, it's like I get to feel guilty for wanting more, but then I also get paid. So it satisfies my my economic self. Now, when you're in this position and you're deciding, do I take that trade? What we want to do is have some reasonable expectation of why I think it can go this far, and why that the amount of risk that I have is worth the venture of 2 or 3R in that direction. I want favorable reward to risk ratio with evidence and confidence based on what planning norm. So here's 2 ways that you might use Elliott Wave or some other methods to estimate the size of this move. The first best one is what just happened, and the bigger this move down, the sooner that this thing fails, the more the fear is coming back. So the bigger the size of this move, leg 1 for me, is the predicted size of leg 2 if this fails. So for me, the best place is just whatever it just did. The second thing I can do is I can go back through my back tests and whatever evidence I've gathered from my forward trading, and I can compute the size of the wins and the size of the losses, and then I can say if I'm looking to trade to the downside, let me find those downward moves and then use statistics to calculate the average fail, the average plus 1 standard deviation, and now once this thing starts failing, I can start predicting sort of like, well, if it just did an average move, it would get there, and an average plus 1 would be there. If it gets beyond average plus 1 standard deviation, this thing is double plus good and yummy. So if I was ever going to add a second position, it would be right on that threshold, because I am certain that nobody else in the planet does it that way. So they're not trapping me. I'm just using math. So as you start looking at estimating the trades that you want to take, you might consider how to standardize your reward to risk ratio and your norms. And when you're using those Elliott waves, you could be using those support and resistance levels as ways to start estimating the reasonable moves to each next place that it could reverse. So if it moved down to here and then started to reverse, you're not allowed to be surprised because we went up. So you can start using the Elliott wave structure to start constructing your DR Barton price ladder and start looking at all the decision points in the life cycle of this trade. So if you think back to that R1 to R10 ladder of manageable moves, you could start identifying certain points in that price ladder where a decision is going to be made by the market and the traders. And if I took this risk and it's going up and it didn't fail, hey, great, I'll just move my stop up underneath that and lock in all the goodies. And this is a way that you can start managing your trade using the initial structure of the setup that you used. And each time that it continues to go in your way, you're gathering information about how good this trade is or not. And when it fails, you can just say, oh, well, that was the size of that move. That thing now comes over into here and becomes part of my database of ongoing statistical analysis of the performance of the symbol or the trade or the pattern or whatever it may be. I always defer to what I can see most recently because that's on the mind of the people that are trading it along with me. But I also use statistics because sometimes we start off in that little sideways quiet channel and I need to have some reason to believe why it could go that high or that low. This kind of statistical assessment gives you the initial breakout and then the estimate of the distance it can travel, and then you can start picking up Elliott wave structure once the initial move goes. You'll find that to be a genuinely robust idea on how to trade a quiet channel or how to trade it at a turning point. What's the size of the manageable risk box? It gets to a turning point, I'll cut it in half. Which way are you going to go? I don't care. I'm following you. So, I have found this to be robust intraday and fast swing trading on hourly charts, swing trading on daily, slow swing trading on weekly charts. This generic approach to how to set up the turning point or the channel as a function of reward to risk ratio with documented planning norms that come out of the research that you've done. Use the power of your mind to help the monkey who's making the decisions make a good decision. But respect the fact that the monkey is always worried about what's going on in here. And that's where confidence in your system may start to erode unless you have it backed up with bulletproof confidence based on performance and statistics and sound money management that is using the, we talk about markets money. Add this to your repertoire, the system's earned money. All right, so think of it now, you've got your money, and then Van talks about markets money, where you can do some creative things with it out here.
Yeah.
Put systems money in there. What did that system earn and get your risk money out of it, and now it's allowed to grow up to be a full production system. It's using its own money. Well done. But you preserved the money that you initially ventured. So add systems money to your frame of reference between my money, markets money. Put system money in there, and then that will help you transition to larger scale in a measured way. So it's not all or nothing. Hey, I back tested this system forever, and now I'm going to put all my confidence in it. Really? Is that what you're going to do? No, you're not. Because your monkey is worried about that. Mine is. So this little production, this is how you manage production in the industrial world. You prove it with facts, and then you scale on the basis of math. Not feelings, math. But you respect the fact that it's your feelings that are allowing you to take that initial risk whichever way you're going. But it's based on a framework that's going to be good for your monkey. Your architect has protected your monkey, and now all your monkey has to do is have the emotional courage to pull the trigger. As soon as the monkey pulls the trigger, if I'm going short from here, there's my entry, and here's my risk. As soon as this thing moves in my direction towards the goal, hooray, bananas. No, my job is to get my stop past my entry point so I can lock in some gains, and that makes my monkey very happy. That's how she stays calm. Then the rest of this is just a science project. I don't know how far that Elliott is going to wave. Go ahead. I know how to manage the stop until the Elliott stops waving, and then that was the size of the trade. Pure science project. And that becomes data, and that updates my decisions, and I look at large numbers of trades before I tinker with a well-tested, well-designed system. Over.
Thank you, Ken. Richard, a couple of things. Okay.
Yeah, I want to add a comment about framework versus system. I think a healthy way to approach is to have a framework and then find systems in those locations, because then you'll have actually a consistency already built in that puts these systems in relationship to each other. The other way I've seen people do is like they wanted a swing system, so they did that. Then they needed a channel system, and they did that. And so that you ended up could have really different beliefs, and then there's no integrating belief system, and it is very challenging to switch views back and forth. Starting with a strong framework, in my view, like Elliott, allows you to develop a family of systems that share common ideas and best practices and planning norms, and it makes development of a range of systems, I think, easier. So I would just that would be another comment about the art and science and practice of system development I've learned. Over. So therefore, they're great. I use probably just a monkey style. I'm not sure what Fibonacci translates into monkey speak, but I mean basically halves and thirds, quarters, and then the tenth. So I almost look at it in terms just the 10 segments, and then I know Fibonacci's in there somewhere, and I know the stats for plus 1, 2, and 3 standard deviations, what that represents percentage-wise. Those, 68.2371% versus 2/3. I'll give you the difference. You know, it's more than half and less than 3/4. So I think in that sense, it has a very sound mathematical basis. It translates into other related visual estimates nicely. It has enough traction in the world that it is a self-fulfilling prophecy anyway. So even if, especially if you don't believe in it, you should be looking at it as a reminder that in the world of 1 billion traders, only one of them thinks exactly the way you do. The other ones are seeing something completely different. So to me, the natural alliance between Elliott and Fibonacci is sound. The principles are excellent. But like anything, I would measure it with a micrometer, I would mark with a crayon, and I would cut with an axe and hit it twice. You know what I mean? So that would be my thought. It's if you're already quant oriented, you can slap those on there nice and easily, and I think it's better to use them than or have them and not need them than not have them and need them. It all gets to the size of the move. Why do I expect it to move that far uncontroversially? I'm just looking for a non-controversial move. I don't want it to be so reliant on magic that it needs magic to work. No. Reasonable moves. Fibonacci is absolutely reasonable. Over.
Thank you.